Sound of cash register upbeat, energetic music fades in and out. Welcome back to the channel, Financial Navigators. Today, we're diving deep into the fascinating world of hard-to-borrow stocks and the mechanics of a short squeeze, using a real-world example that's currently on our radar, ZCMD. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show ZCMD ticker on screen. Let's talk about ZCMD. This is a microcap company, meaning it has a relatively small market capitalization. Its sector, while not widely reported or defined, does not diminish its appearance on our hard-to-borrow screener. What really caught our eye with ZCMD isn't its sector, but a truly eye-watering cost-to-borrow fee of 846.6% annualized. Zoom in on 846.6%, we're also looking at an estimated float of just 1.1 million shares. Now, before anyone gets too excited, it's critical to note ZCMD's recent trading activity, a completely flat 0.0% change today, over the last 5 days, and even the last 30 days. And here's the kicker, today's volume was 0 shares, matching its 30-day average volume of 0 shares. This means despite what the numbers might imply about borrow rates, ZCMD has been entirely dormant recently. What is cost to borrow and why it matters? Animation, shares being borrowed and returned. So, what exactly is cost to borrow, or CTB? In simple terms, if you want to short a stock, that is, bet against its price by borrowing shares, selling them, and hoping to buy them back cheaper later, you have to pay a fee to borrow those shares. Think of it like paying rent for an apartment. The cost to borrow is this rental fee, typically expressed as an annualized percentage. Why does it matter? A high CTB indicates strong demand from short sellers to borrow the available shares, or, more often, a very limited supply of shares available to lend out. When these fees climb above 100%, it signals extreme conditions in the borrow market, making it incredibly expensive to maintain a short position. Why this stock is hard to borrow right now. Highlight CTB number and foot size. ZCMD landed on our hard-to-borrow screener precisely because of its current dynamics. With an annualized CTB fee sitting at an astronomical 846.6%, it tells us that shorting ZCMD, if you can even find shares, is extraordinarily expensive. Couple that with an estimated float of only 1.1 million shares, a tiny number in the grand scheme of the market, and you have the ingredients for an incredibly tight supply of borrowable shares. Our internal composite squeeze score for ZCMD currently sits at 42.5, which considers factors like CTB level, float size, and technical setup. However, it's vital to bring us back to reality. A known number of shares currently available to borrow, combined with the fact that ZCMD has shown absolutely zero trading volume or price movement for weeks, tells us that, while the potential for squeeze scenario exists based on borrow rates, there's currently no activity to ignite one. It's like having a match and kindling, but no spark. Squeeze mechanics explained. Animation, short sellers covering, price rising. Let's quickly demystify the short squeeze. When short sellers borrow shares and sell them, they eventually have to cover their position by buying those shares back from the open market and returning them to the lender. If a stock's price unexpectedly begins to rise, short sellers face increasing losses and higher CTB fees. This pressure can force them to buy back shares rapidly to cut their losses, which in turn drives the price up even further, creating a domino effect known as a short squeeze. A shrinking supply of borrowable shares, like ZCMD's small 1.1 million share float, makes it even harder and more expensive for short sellers to maintain their positions, potentially accelerating the squeeze dynamic of trading activity and positive price momentum which has suddenly appear. But remember, for ZCMD right now, that is key, given its zero volume. Dilution risk check. Show no dilution risk graphic. Now let's talk about dilution. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This influx of new shares can lower the value of existing shares and, critically, can provide a fresh supply of shares for short sellers to borrow, effectively neutralizing or negating a short squeeze thesis even if the cost to borrow is sky high. We always check for this. For ZCMD, our check found no recent dilutive SEC filings like SMINUS1, SMINUS3, or 424B in the last 90 days. We also found no recent reverse splits in our look-back window. This is a positive sign, as it means one major potential headwind against a squeeze, should one develop, is currently absent for ZCMD. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show ZCMD chart with potential movement. So, what does all this mean for ZCMD? While its astronomical 846.6% CTB and tiny 1.1 million share float paint a picture of extreme borrowed pressure, we must temper that with the current reality, zero trading volume and price movement. A high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have incredibly strong conviction in their bearish thesis and are willing to pay exorbitant fees to maintain their positions. For ZCMD, the absolute primary thing to watch for would be a significant, sustained increase in trading volume. Without volume, the high CTB is largely a theoretical indicator. Should volume pick up, then monitoring the available shares to borrow, price momentum, and any changes in the CTB rate would become crucial. Call to action graphic. ZCMD offers a fascinating case study into the mechanics of hard-to-borrow stocks. We have an incredibly high cost to borrow and a minuscule float, yet the stock remains dormant. It's a perfect illustration that while these indicators are important, they are only pieces of a larger puzzle. A true squeeze requires active trading and price catalysts. Always prioritize education and risk management in your trading journey. If you found this deep dive into ZCMD and short squeeze mechanics helpful, please hit that like button, subscribe for more unique stock analysis, and let us know in the comments what other stocks you'd like us to analyze next. Until then, stay smart, stay safe, and happy trading. Music fades up.